You know, many investors call us because they have a gut feeling that the dollar is being inflated away and going to zero. And frankly, they're correct. Not only because of the unprecedented money printing by the Fed, resulting in all of the bubbles that we see everywhere, but also the radical increase of social change since the pandemic started. It all seems to be justifying the next set of changes that, quite honestly, I don't want to see, and I don't think you really want to see. And based on my research of historical data from previous currency resets, and there are lots of them all around the world, I've been preparing for this event, frankly, since 2008. And even before that, but I didn't think I'd see it in my lifetime. You know, it's all based on the life cycle of currencies. And we just didn't know that it was going to come now. The fact is, we're nearing the end. And it is my job to warn you while you still have time, you still have choices. I'm seeing is that central banks, and we've been talking about this, but they really are losing control. Even recent history is any gauge, they will not succeed at it. And why won't they succeed? Because they gave the market over to the traders. Because Wall Street and the financialization of the entire global economy, well, you know, they've been working on it for a long time, but when the banks are in charge, what do you expect? The TYVIX, which they no longer publish because they really don't want anybody to know what's happening underneath the surface. This is the U.S. 10-year Treasury bond. And look, prior to 2008, it was like a straight line. In other words, the price did not move a whole lot. It was not volatile. It was pretty solid for a 10-year Treasury, which frankly is what you want in a foundation. You don't want a foundation that's shifting and moving all the time. You want something that's rock solid, not what we have anymore. In 2008, when the system died, what was once a dash then became a short line. And you can see it, it's really obvious. And look at 2013, because that's when the shift to the traders taking over the control of those markets really, really started. And this is so significant, and I'll show you why, because a lot is now happening around the world, and we have to pay attention to this, because just as this is in Australia, guess what? It's going to impact everybody. Central banks are experimenting. Now, of course, and they've been experimenting. Now, what's interesting particularly about Australia is that, like Japan, who made a failed attempt at yield curve control, and yield curve control is about a central bank controlling every area of the bond market. We saw back in 2015 where the central banks, with the Swiss surprise, that central banks no longer trusted each other. Then we also saw, started 2008 when interbank lending plummeted because banks did not trust banks to pay back their debts. Then 2015, it was central banks realized that a central bank over here, they may say one thing, but when it comes to defending their currencies or for whatever benefits their little area, they're going to do whatever they want, regardless of what they say. That's just what happened in Australia, too. They said, no, we're defending it, we're defending it, we're defending it, until they didn't defend it. And the last vestige of confidence is in the public, confidence in those central bankers. But here, 40 years of a bond bull market has driven debt levels to new highs. There you go. I mean, you know, what can I say? They had a lot of ramp room. And since this was their tool, can you see how they've lost their tool? Because we're anchored at zero. Now, we'll just pay attention and see if they can pull this off and raise those rates. I personally don't think so, because every single attempt failed since 2009. Every single attempt, including the attempt here in the U.S. So interest rates down, debt levels up. That's it. Now, the other thing that I wanted to talk to you about is what's happening in the real estate market. Because Zillow, I don't think this is a one-off. The way that Zillow was doing it, was really, it was a new way. I didn't think it made a whole lot of sense. And here, they're proving it right. We'll see if this then spirals into other house flipping businesses. But my bet is that it will. Why are home prices up so much? We've talked about it. Because Wall Street is involved in home prices, right? The decision to abandon home flipping comes at the company's third quarter results showed a loss of more than $380 million in the operation. The business hit a major snag in recent months as Zillow tweaked its algorithms to make more aggressive offers, causing it to overpay for houses. Now, listen to this last part, please. Just as the heated U.S. market began to cool slightly. Fundamentally, we have been unable to predict future pricing of homes to a level of accuracy that makes this a safe business to be in. Shocker. Earlier this year, the company borrowed. Who'd they borrow from? Did you buy any Zillow bonds? More than $1 billion through 2 bond offerings, making it the first iBuyer to tap the securitization market. It has also lined up $500 million credit facilities with Credit Suisse Group AG, Goldman Sachs, and Citigroup. Now, here's the point. This is what Wall Street has been doing, actually. And in the real estate sector, going in, they've got access to basically unlimited funds at basically no interest rates or extremely low interest rates. What we're dealing with here is so much bigger than a recession. This is a complete reset socially, economically, as well as financially. And when it gets really, really bad, and remember, people have been, living with this fear for quite some time now. So people are really on edge. And a crisis can justify, if people aren't paying attention, can justify what they want to do next. Don't buy it. Don't buy it. This quietly and invisibly protects your wealth.